So the next component of the shareholders' equity is the retained earnings. And the often problems related to retained earnings is on the dividends. So retained earnings represent the cumulative profits or the net of losses, distribution to owners, and other adjustments which are not yet distributed as dividends but rather retained to be reinvested in the business to settle debt. Total retained earnings may consist of unappropriated or the unrestricted retained earnings which are available for future distribution as dividends. And then we have the appropriated portion which is not available for distribution unless the restriction is subsequently reversed. So the dividends, as mentioned already, because of the unappropriated portion, this is available for distribution. So there would be dividends that will be distributed. So dividends are distributions to shareholders, and this may be in the form of cash dividends, liability dividends, property dividends, or it could also be share dividends. So cash dividends are distributions in the form of cash, and liability dividends are dividends issued by a corporation that has a temporary cash shortage, and it can either be a scrip dividend, which is short term, and bond dividends, which would be long term. But this is uncommon nga form of dividends. Ang common is kaning cash dividend. Then we have the property dividend. Then property dividend are distributions in the form of non-cash asset. And we also have share dividends, which is also called as bonus issue or stock dividends. And this is distribution in the form of entities' own share. So when we are talking about dividend distribution, so there are important dates to remember. So we have first the date of declaration, which is the date that the board of directors formally announces the distribution of the dividends. So nag-declare, nag-announce nga na ay dividends nga i-distribute. Then the date of record, it is the date on which the stock and transfer book of the corporation is closed. So only those who are listed as of the date of record are entitled to receive the dividends. Then we have the date of distribution. It is the date when the dividends declared are distributed to the shareholders who are entitled to the dividends. So to provide shareholders ample time to register, they are normally allowed to register about 3 to 5 days prior to the date of record. Okay, remember, you can only receive the dividends if you are registered at the date of record. Otherwise, wala kay labot sa dividends kung wala imuhang lista or wala imuhang name sa lista o as of the date of record. Under IFRIC 17, the liability to pay a dividend shall be recognized when the dividend is appropriately authorized and is no longer at the discretion of the entity, which is the date when the dividend declared by management is approved by a relevant authority, and or the date when the management declares dividends if further approval is not required. With regards to dividend declaration and dividend distribution, we need to determine the outstanding shares. Kaya ang basis sa pag-distribute sa dividends would be on the outstanding shares. So cash dividends are most common form of distribution to owners, And these may be declared as a certain amount per share or as a percentage of the par value of the shares. So only outstanding shares are entitled to receive dividends. So outstanding shares pertain to issued shares and held by the shareholders and those that are subscribed. So therefore, shares issued plus subscribed. So walay labot ani ang treasury shares. That's why we need to deduct. Okay? So exclude unissued and treasury shares. So therefore, i-minus dapat ang treasury shares. Remember, di ba, nga ang treasury shares kay re-acquired na siya nga issued shares. So, na-issue na nato niya atong gipalit. So, therefore, nabilong na siya atong issued nga shares before. So, to get the outstanding shares, we need to deduct the treasury shares. So, therefore, outstanding shares is equivalent to issued plus subscribed minus treasury shares. For property dividends, the liability will be recognized and accounted for as follows. So at the date of declaration, you will initially measure the property dividends at fair value of the non-cash asset. Then at the end of each reporting period and also on the settlement date, you need to adjust for any changes in the fair value. The changes here will be recognized as gain or loss directly in the retained earnings. And on the settlement date or the distribution date, any difference between the carrying amount of the dividends payable and the asset distributed is recognized in the profit or loss. So accounting for non-cash assets declared as property dividends would also consider the following. So if the property dividend is a non-current asset, it shall be subject to the requirements of PFRS 5, reclassified as non-current asset held for distribution to owners, and subsequently accounted for under PFRS 5. A non-current asset held for distribution to owners is initially and subsequently measured at the lower of its carrying amount and fair value less cost to distribute. And what are examples of this property dividends? So, pwede nga, ang dividends nga ipanghatag ka in the form of inventory ba na siya, building, so mga non-cash assets. Pwede pod, entities own share, not entities own share, sorry. Pwede pod, entities own investment in equity shares. Meaning, naa sila investment sa laing company in the form of shares, unya ka to may ilahang i-distribute sa ilahang mga shareholders. Okay? Pero pag ang own shares ang ilang ipanghatag, that is called as share dividends. Pag own shares sa company ang i-distribute, that is share dividends. Pero kung shares nila, gi-own nila sa laing company, silbing investment nila sa laing company, mo ilang ipanghatag sa mga shareholders, ang tawag adto is property dividend. Okay, again, if the company is distributing its own shares, ilang kaugalingong ordinary or preference shares, that's a share dividend. But if they are distributing shares that they own in another company, okay, investment nila sa laing company and they distribute that to their shareholders, then that is a property dividend because that investment is considered as an asset. Okay? Asset to nila. So, non-cash siya nga asset. If the property dividend is a current asset, it shall be accounted for under its previous accounting and no reclassification is needed. So, share dividends accounting, okay? So, di ba I have mentioned ganiha na if you are distributing to your shareholders shares of stocks, your own company's shares of stocks, and not investment in shares in another company, then these are share dividends. And in the share dividends, there are two types. We have the small and the large share dividends. Small share dividends are share dividends that are less than 20% of the outstanding shares. And we already know how to get the outstanding shares, diba? Outstanding shares is equivalent to issued shares plus subscribed minus treasury shares. So if it is less than 20% of the outstanding shares, the share dividends are accounted for at fair value. But if the share dividends is at least 20% or pwede po more than 20%, then the shares are accounted for at par value. So what do you mean by accounted for at fair value, ma'am, or accounted for at par value? So if it is at fair value, na possibility nga mag-recognize ta og share premium. But if it is accounted for at par value, so wala siya share premium. Kaya dili man siya mo above sa par. Wala may excess beyond sa par. So again, kung fair value ang measurement, na ay chance nga mag-credit ta og share premium. But if it is recorded at par, wala siya credit to share premium. So preference shares have one or both of the following preference over the ordinary shares, which is also identified in the previous discussion nato. So they have preference in distribution of assets in case of corporate liquidation. And they also have preference in the distribution of dividends when declared or preferred as to dividends. Dividends declared on equity instruments are charged to retained earnings, and dividends declared on financial liabilities such as redeemable preference shares shall be charged to profit or loss as interest expense. Then, if the dividends are declared out of capital rather than from retained earnings, they are called as the liquidating dividends. And liquidating dividends are normally declared only upon corporate liquidation. However, the wasting asset doctrine permits wasting asset corporations to declare dividends out of capital during their existence. Then, what are the disclosures needed for dividends? So, dividends declared and the related amount per share are presented either in the statement of changes in equity or in the notes. Dividends declared after the reporting period but before the financial statements are authorized for issue are not recognized as liability at the end of the reporting period because at that time, at the end of the reporting period, wala pa may liability or wala pa obligation that existed. So the dividends are therefore only disclosed in the notes. Now let's proceed to other components of the equity. So we have the revaluation surplus, cumulative unrealized gains or losses on fair value, changes in investments in FVOCI equity securities, exchange differences on translating foreign operations, and effective portion of cash flow hedges. First is we have the recapitalization, which refers to the change in the capital structure of an entity brought about by the cancellation of old shares and issuance of new shares as replacement. So it is accomplished through any of the following: change from par to no par or vice versa, reduction of par value or stated value, share splits or reverse splits, or recapitalization that does not affect the assets, liabilities, or total shareholders' equity. When talking about share split, it could be a split up or it could be a split down. So when we say split up, it occurs when the old shares are canceled and replaced by a larger number of shares. So, mo daghan. That's why it's split up. As a result, kahing daghan man ang number of shares, but the total value, ang total gihapon niya in peso amount is the same, pero nanaghan ang shares, ang per share nga value would be lesser. In total, it's the same, but since daghan naman siya og shares, so inig-divide nato sa number of shares, mugamay ang iyahang par value or ang stated value per share. Opposite sa split up is a split down whereby the old shares are cancelled and replaced by a smaller number of shares. So since nagamay ang number of shares, the par value or the stated value per share will increase kay mas gamay naman ta og ipang divide. Then we have the term Quasar Reorganization. So Quasar Reorganization is an accounting procedure whereby a financially troubled corporation but with favorable future prospects is permitted but not required to revalue its assets and liabilities and realign its equity subject to the provisions of relevant regulations in order to establish a fresh start in accounting sense. Quasi-reorganization may be effected through revaluation of property, plant, and equipment, or it could also be through recapitalization. The basic approach to quasi-reorganization is as follows. The assets and liabilities are revalued upwards or downwards. Any resulting credit balance in revaluation surplus is used to wipe out any deficit. If a recapitalization is made, any resulting share premium shall also be used to wipe out any deficit. Then disclosures required by relevant regulations are provided in the financial statements for a minimum period of 3 years. Okay. If you like this video, don't forget to click like, subscribe, and hit the notification bell to be updated with the latest video lessons. Thank you for watching.